Warren Buffett is widely considered the greatest investor who has ever lived. He has spent over 60 years picking individual stocks, studying businesses, and building one of the largest fortunes in human history. Nobody on earth has more experience choosing where to put money than Warren Buffett. And his advice to ordinary people, including the instructions he left for his own wife's inheritance, is this: don't do what I do. Put 90% of your money into a simple index fund and leave it there. That recommendation should stop you in your tracks. Because if the greatest stock picker in history is telling regular people to skip stock picking entirely, you need to understand exactly what an index fund is, why it works, and why almost nothing else in investing comes close for the average person. That is what this video is about. In the next 10 minutes, we are going to cover exactly what an index fund is in plain language, why they outperform the vast majority of professional money managers, how much they actually cost versus actively managed funds, and which specific index funds are worth looking at in 2026. No jargon, no assumptions. Just a clear explanation of the investment that has quietly built more ordinary wealth than almost anything else in the history of financial markets. This is Wealth Clarity. Let's get into it. Let's start from the very beginning. The stock market is made up of thousands of companies. Large corporations like Apple, Microsoft, Amazon, and Google, all the way down to smaller businesses you have probably never heard of. When you buy a share of stock in one of these companies, you own a tiny piece of that company. If the company does well, your share is worth more. If it struggles, your share is worth less. Now here is the problem with buying individual stocks. You are making a bet on one company, and even the most experienced investors in the world get that bet wrong more often than you would expect. An index fund solves this problem by doing something beautifully simple. Instead of picking one company, it buys all of them. Specifically, an index fund tracks a market index, which is a predefined list of companies grouped by certain criteria. The most famous index is the S&P 500, which is a list of the 500 largest publicly traded companies in the United States. To be included, a company must have a market value of at least $22.7 billion and must have been profitable for at least 1 year. When you invest in an S&P 500 index fund, you are not buying one company. You are buying a tiny piece of all 500 of them simultaneously: Apple, Microsoft, Amazon, Google, Berkshire Hathaway, Visa, Johnson & Johnson, and 495 more, all in one single investment. If one company in that list has a terrible year and loses half its value, it barely moves your overall investment because it represents a fraction of 8% of the whole. If the broader US economy grows, which over long periods of time it historically has, your index fund grows with it. That is the core idea. Own everything. Benefit from the whole market's growth. Remove the risk of any single company destroying your investment. Here is the part that surprises almost everyone who hears it for the first time. Professional fund managers, people with finance degrees, decades of experience, teams of analysts, and access to data ordinary investors never see, cannot consistently beat a basic index fund. This is not an opinion. It is one of the most thoroughly documented findings in all of investing. The SPIVA research, which stands for S&P Indices versus Active, has been tracking this comparison for over 20 years across every major market in the world. Their most recent findings are striking. 95% of actively managed large-cap funds have underperformed the S&P 500 over the past 10 years. Not occasionally, not in bad years, consistently across an entire decade. An independent analysis confirms what that means in real money terms. The average actively managed US fund delivered a total return of around 200% over the past decade. The S&P 500 delivered 328% over the same period. Investors in active funds made roughly 60% less money than investors in a simple index, and they paid higher fees for the privilege. Why does this happen? There are two main reasons. The first is cost. Every actively managed fund charges fees, typically between 0.5 and 1.5% of your investment per year, to pay the fund manager and their team. That sounds small. But over 30 years, 1% per year in fees on a growing portfolio is the difference between hundreds of thousands of dollars. The second reason is harder to accept but just as important. Markets are remarkably efficient. The price of any stock at any given moment reflects the collective knowledge and opinion of millions of professional investors, analysts, algorithms, and institutions, all simultaneously trying to find underpriced companies. In that environment, consistently finding stocks that everyone else missed is extraordinarily difficult. Not impossible, but difficult enough that fewer than 5% of professional managers manage it over a 10-year period. An index fund does not try to beat the market. It simply becomes the market. And over long periods of time, that turns out to be the smarter strategy. One of the biggest reasons index funds have exploded in popularity is their cost. Remember those fees we talked about, the 0.5 to 1.5% that active funds charge? Index funds charge almost nothing by comparison. The Fidelity 500 Index Fund, one of the most popular index funds in the world, charges an expense ratio of 0.015%. To put that in real numbers, on a $10,000 investment, you pay $1.50 per year in fees. That is not a typo. $1.50. Fidelity also offers their FZROX fund, the Total Market Index Fund, with a 0% expense ratio. Literally nothing. Free to own. Vanguard's VOO and VTI both charge 0.03%, about $3 per year on a $10,000 investment. Compare that to an actively managed fund charging 1%, $100 per year on that same $10,000. The difference compounds dramatically over decades. By retirement, the gap between a 1% fee and a near zero fee on a growing portfolio can easily reach 6 figures. In 2025 alone, passive index strategies attracted $353 billion in new investment, while more than $375 billion left active funds. That shift has been building for a decade and shows no sign of slowing. Investors are voting with their money, and they are voting for index funds. Not all index funds are the same. Here are the 3 categories every beginner should understand. The first is the S&P 500 Index Fund. As we covered, this tracks the 500 largest U.S. companies. It is the most widely recommended starting point for beginner investors. Historical average annual return, approximately 9 to 10% over long periods. The S&P 500 is itself up 8% so far in 2026, after a volatile start to the year. Representative funds, VOO at Vanguard, FXAIX at Fidelity, SWPPX at Schwab. The second is the Total Market Index Fund. This tracks the entire U.S. stock market, not just the top 500 companies, but over 3,600 companies of all sizes. It gives you even broader diversification. Performance is very similar to the S&P 500 over most periods. Representative funds, VTI at Vanguard, FIROX at Fidelity with 0 fees, SWTSX at Schwab. The third is the International Index Fund. This tracks companies outside the United States, Europe, Asia, emerging markets. It adds global diversification and reduces your dependence on any single country's economy. Most financial advisors suggest some international exposure for a complete long-term portfolio. Representative funds, VXUS at Vanguard, FZZLX at Fidelity. For a beginner starting today, the simplest possible approach that financial professionals consistently endorse is this: one S&P 500 or Total Market Index Fund in a Roth IRA with automatic monthly contributions. That is it. That is the strategy. You do not need anything more complicated than that to build serious long-term wealth. So let's bring this all together. An index fund is an investment that buys every company in a predefined market index rather than picking individual stocks. The most common type tracks the S&P 500 shares, 500 of the largest U.S. companies, giving you automatic diversification across the entire U.S. economy in a single investment. Index funds beat roughly 95% of professional fund managers over 10-year periods. Not because they are clever, but because they are simple, consistent, and cheap. They charge almost nothing in fees, they require almost no management, and they have historically returned 9 to 10% per year on average over long periods. Warren Buffett did not recommend index funds for ordinary people because he couldn't think of anything better. He recommended them because after 60 years of studying investing, he concluded that for people who are not going to dedicate their life to picking stocks, owning the whole market at near zero cost is genuinely the best available option. That option is available to you today, with as little as $1 through fractional shares at Fidelity, Schwab, or Vanguard. The only mistake is waiting. If this video gave you a clearer picture of what everyone keeps talking about, subscribe to Wealth Clarity. New videos every Wednesday and Saturday. No jargon, just clarity. YouTube is going to show you the perfect next video right on your screen now. I'll see you on there.